Okay, so we are going to pull up our presentation. And can everyone see the screen right there?
I can.
I was
Okay,
going to say
let's,
it's still loading on my end. Oh, there it is.
There we go.
okay. Well, I'm going to minimize us, but here we have the screen right here. So I just want to introduce everyone. So this is Karla. Karla has been so kind to agree to talk with us tonight, like it says right there about the flexibility of FHA loans. And I think, me being a realtor and maybe some other realtors are on here or even consumers, I think a lot of times we think of FHA as just like if you say that a first time home buyer's loan or something like that, I think that's very common. Would you agree?
hmm Yeah, I
Mhm.
think there's a lot of maybe myths attached to FHA loans or um, maybe just some preconceived notions that I think people will be pleasantly surprised to find out things are a little different than maybe what they've heard.
I agree. I agree. So, this is Karla. Karla, can you tell us just a little bit about, how long you've been in this industry and just maybe a little bit about yourself?
Sure, sure. I am Karla Hendricks. I'm with Approved Mortgage and I'm on the south side of Indianapolis. I have actually been a loan officer for about 3 years. So, in the grand scheme of things, not as long as some of my peers, which have, done it 20 or 30 years, but I love it. I learn new things every day. And really, my passion is to just help people find what's the good fit for them. Educate people because honestly, the first couple times I bought a home, I did not know what steps to expect. There was a lot of unexpected things. It just seemed like a big mystery. And so I want to take some of the mystery out for people and just let them know what their options are, what the steps are, and just what's out there, what can help them meet their goals. So that's what I love about it.
Well, I love that. And it is true because I have actually worked with Carla and she is excellent. She loves working with the buyers and educating them. And I think that's so important because, you know, a lot of people out there, a lot of buyers, they're scared. They don't, maybe they don't know a lot about the different loan programs. And I really love that you talk with them about the different options. And this is going to also be not just for maybe first time buyers say this is going to be for people who actually even own a home or are thinking about selling, and I'm so excited for you to go into it. So I'm just going to let you start. You just tell me when to change the slide and we're
Okay.
ready to go.
Awesome. Thanks, Jennifer. And I've enjoyed working with you on, we've done a kind of a buy and a sell together, or so, or I
Yes.
guess flip that around. But,
Yeah.
and you're very, very detail oriented and really look out for the best interest of all your clients. So I truly appreciate that.
Oh, well, thank you
You
so
can go
much.
ahead and flip to that first slide. Thank you.
Okay.
So this is just kind of a little nutshell to get started. Just a little bit about an FHA loan. An FHA loan, you might hear people say that it's a government loan. It's truly not. FHA loans are private loans, just like conventional loans are. The difference is that they are insured by the government. So people normally will have some mortgage insurance with an FHA loan. That insurance is backed by the federal government, and that's what makes an FHA loan oftentimes appealing because you can get a lot of times a lower interest rate with an FHA than what you can with even like a side-by-side conventional for the same dollar amount in the same area. Just because there's a little bit of that the government being the insurer behind that makes that loan less risky. And so that's why that sometimes you can enjoy a lower interest rate even with an FHA loan. It is great for first-time home buyers, but it is not limited to first-time home buyers at all. You could use an FHA loan 10 times throughout your life. If you buy and sell or you move, you go somewhere else. So it's definitely reusable. It's not just for first-time home buyers. Um, it does have flexible credit and income guidelines, which is what makes it kind of ideal for first-time home buyers sometimes because over the last couple of years, and I'm sure Jennifer, you've seen this, that prices have risen of homes. And so entering into that, to being a home buyer for the first time is a little bit more of a step. And so FHA just makes some of the parameters a little bit easier to fit into, which I really like that a lot. And it's just kind of overall framed for making home ownership more accessible for people.
Can I ask you, so why do you think that there's such a notion or an idea that, oh, this is just a first time, home buyer's loan? Where do you think that concept came about? Because I hear people asking me or saying that all the time.
Hmm. I think honestly, because with a conventional loan, um, a lot of times people associate that with you've got to put 20% down,
Hmm.
which is also another myth, but it
Yes.
is kind of a thought out there. Conventional loans can be as low as 3% down for some
Mhm.
people. So it's pretty amazing too. But I think that a lot of people associate conventional loans with more seasoned homeowners because maybe if you sell one home, you have that equity, you can put it into another one, have that 20% down that they think is needed.
Mhm.
Um, but I think that's probably why the FHA
Okay.
with a 3.5%, well, the down payment can be as low as it normally is, as low as 3.5%. There are instances where it can be a little higher, but um, I think that's probably the reason why people associate it
Okay.
with first-time home buyers. So, government insured confidence on this kind of loan. Um, like we were saying a minute ago, because the government does do the insurance behind it, lenders find it a less risky loan to take on, and so they're willing to give a lower interest rate to kind of negate that lower risk. So, or to, that's not probably the right way to say it, to reward that lower risk.
Mm.
Um, is why we see the lower interest rate. Easier qualification. The reason that we have that in there is because FHA is, well, each loan type has a debt to income ratio that federal regulations will apply. So with a conventional loan, the debt to income ratio that's allowed is lower than it is with an FHA loan. So we never want anyone to be overburdened with a home payment. So we always want to make sure that a home payment fits within their income and within the other monthly debts. Maybe they have a car payment or a credit card. So we want all those debts to fit into a percentage of their income so that they're never overburdened. But of all of the loan types between conventional, USDA, VA, and FHA. FHA has the greatest parameter for debt to income ratio, which means that if someone maybe has some lower income, or if they don't have lower income, but they have other monthly debts, then oftentimes we can fit that mortgage payment into their monthly budget easier.
Got it.
Mhm. So, high debt to income flexibility. Well, this is actually what we were just talking about. I'll just hop down to the low down payment, the 20% myth. Um, like we were mentioning earlier, sometimes people hesitate to maybe look to be pre-approved or to think about buying a home because they think, oh, I need to have 10%, I need to have 20% saved up. And to be fair, if you have 20% saved up, then kudos to you. That means that you either can afford a higher purchase price on a home, or you can just enjoy a lower payment because you're putting more down and having a lower mortgage insurance associated with that payment as well. So, you're just kind of cutting out some of the principal by putting more down. So that's great if you can, but if you can't, the 3.5% is much more attainable than 20 for most people, if they don't have, maybe another home they're selling and that equity to roll over. And the nice thing also about that 3.5% with an FHA is that it can be gifted by a family member. So, or in some instances, a close friend. I've had clients where they were engaged, one was buying a house, the fiance was able to gift part of the down payment to the other fiance. So, that worked well. And another strength about it too is that seller concessions can be up to 6% of the purchase price, which is a lot. And if anybody, Jennifer, I'm sure you hear that word all the time. You're a great negotiator. Do you want to just like pipe in there and say, like, kind of explain what seller concessions are?
Yeah, and I love that because, like you said, 6%, that is a great amount. So, for example, if a buyer really loves a home, we actually could go to the seller and ask them, for example, for closing costs or, any of those type of things. And like you said, up to 6% is great because I know that for some other loan programs, it's a little less. Isn't that
It
right?
is. Yes, it is. It can be as low as 3% with a conventional loan. So it is really nice to have that flexibility. And not that the seller is required to pay that, but it's definitely part of negotiations, isn't it? So
Absolutely.
it
Yeah.
can be wonderful if a buyer has their 3.5%, they're ready to do their down payment, but maybe they don't have enough in savings to cover closing costs. So a realtor can negotiate with that seller to ask them to pay some of those closing costs. And in some instances, even use some of that, what we call seller concessions, to even buy the interest rate down for the
Mhm.
buyer even lower. So it can be used for a lot of really beneficial things.
It's really nice.
Mhm. Oh, so house hacks with FHA. I love this. This is something that I don't think a lot of people are aware of. You might hear investors doing these things, buying a
Mhm.
duplex or a triplex or a fourplex, a quadplex, fourplex, we'll say. So a 2 through 4 unit property for residential. And they do that all the time. But with an FHA loan, you can do the same thing, not as an investor, because that's a totally different type of loan. An investor would not
Mhm.
live in the property, but they would just buy it, maybe to just rent it out to other people. FHA, and honestly, if they do buy a home for that intention, um, they are going to see at least a 20% down payment, oftentimes a 30%. So it's a very big entry point for an investor to do that. However, if you are looking for your own home and you are willing to look at doing a duplex, triplex, or fourplex, and you're intending to live in one unit, that's the big key. So it would be your own home in the sense that you would be purchasing it, but you would live there as well in one unit, rent the other 3 units out if you're doing a fourplex, or other unit if it's a duplex. Um, it's an amazing hack because that income from the other units, they were looking at a duplex. If if maybe the second unit rented for, we'll say easy $1,000 a month, we can count 75% of that rental income, so $750 a month, as qualifying income for the borrower. So they may be able to buy something in that case that maybe they don't have all of that, maybe enough qualifying income with just their wages. So that's a way that they can actually buy a home and use some of the rent from the other units as their own qualifying income. It's pretty amazing.
I love that. And that is really, really smart. There are tons of duplexes, triplexes in
Mhm.
Indianapolis and even in the surrounding suburbs. And yeah, people should definitely take advantage of that, especially if,
Yeah.
they're trying to buy their first home. And that's just really smart.
Mm. Okay, so great. This is another really interesting house hack for FHA. We usually just think of FHA as a program that has a very strict appraisal process, and it does. And so, and Jennifer, I'm sure you've run into this too with your buyers and sellers, that FHA appraisals are a little bit more strict in general. And because most people use what we call the regular FHA, it's labeled 203B.
Hmm.
So with that, really, like, things need to be pretty ship shape on the house, like no crumbling foundations, like nothing that would endanger their health or safety to live there. The roof can't leak, there cannot be mildew. If there are any of those items, the seller would need to fix it before the sale could go through. However, FHA has a kind of a flip side to that coin, and it's called their renovation loan. So that is technically called the 203K. Um, the 203K is really neat because, say you find a fixer-upper, and if you have a little bit more time, if you're not in a super tight time restraint that you need to quickly move within 30 days, because the renovation loan can take a little bit longer to close because there's some more steps involved. Um, then that gives you the ability to actually use an FHA loan to purchase a fixer-upper. And as you can see there, there's two pathways within that. There's a standard and the limited. And so basically, in the nutshell, what that means is if you find a home that maybe it just is a really good and sound home. It's got a great roof, a great foundation, good windows, it's safe, it's habitable, but maybe it just has not been updated since 1992 and you just don't like grandma's colors and you just really want to rip all the carpet out and all those things. You could do the limited renovation loan. So those are more for cosmetics and for smaller things. But the price of those things would be rolled into your purchase price. And so that means, like, you wouldn't have to move in and then maybe open a HELOC to fund your changes. And that is kind of the easier way to do it. The kind of the quicker FHA renovation loan. You don't need a HUD contractor to lead that. Now, if there are major things, you want to add a room, you want to put a new roof on, you need to fix a foundation, you want to add a garage, those things actually can be done with some FHA renovation loans. But they do require a HUD contractor. So, and that is HUD is just housing and urban development, which is the overseer of FHA loans. So they have a list of approved FHA or HUD contractors that you would need to use one of those. So if you are thinking about doing an FHA loan and it's a major renovation project, keep in mind that even if you or your spouse or your brother or neighbor know how to maybe renovate a bathroom, rip out plumbing, replace a roof, that you wouldn't be able to do that yourself in that case. You would have to
Okay.
have a contractor approved by HUD. So that is one of the things to consider, but it can really make a lot of homes accessible that maybe other
Yes.
people are overlooking in the market because they need some repairs or updates. They don't want to
Hmm.
bother, or they don't want to have to, close on a loan and then also open a HELOC to do repairs. So this is kind of a one and done. And there is kind of a nice stipulation with the standard FHA renovation loan. So with the bigger projects, if say floors need to be ripped out, you obviously cannot move in at closing. So
Yeah.
what could happen is your first 6 months of payments can actually be rolled into the loan.
Ooh.
So you could continue to live where you are, if you're living with a family member, renting, and then you would those payments, you would see them start at the end of that construction. So it's kind of a neat hack that maybe a lot of people just don't know about.
Well, and I'm glad you mentioned you can roll 6 months of payments in because I can see people being a little nervous because, they can't
Mhm.
live in it. Where are they going to go? The
Right.
timing and all of that. So that's actually
Mhm.
really helpful. And with the
Mhm.
down payment amounts, is it similar to the regular FHA loan where it's the lowest
Yeah.
3.5?
Yeah, great question. It is. It's 3.5, and you're going to see some contractor costs associate, added in because obviously whoever's doing the work is going to have to be paid as well. And there's also a little buffer built in just in case the contractor estimates the flooring would be $5,000 and it comes in at $8,000. So
Mm.
there's a little buffer built in just to cover any costs that change a little bit during the renovation.
Okay. And we need to think about this type of loan and really educate clients on it because there are so many homes out there that, like you said, maybe they wouldn't pass an FHA inspection, but like a typical one. But if they decided to do something like this, even if it was limited, that's a really good option.
Mhm, mhm. If they have a little bit of time, if they're not in such a super tight hurry, to have to leave where they are within 30 days, it's a great option. Oh, so let's touch on this is kind of another FHA hack. And this is called reverse mortgage. You've probably got feelings that come up as soon as you hear that term, reverse mortgage. Some is good and some is like, oh, that's a scam. You've probably seen tons of commercials on TV for it. So it definitely has its pros and cons, and it's not for everybody. But just to touch on it, it can be a kind of a home hack for FHA homeowners that they already own their home. So this would not be actually a mortgage you use to purchase a home, but if you already own your home with an FHA mortgage, you've got, maybe several years in, maybe even 10, 20 years in. So you have a significant amount of equity in your home, but you're still making those mortgage payments. And this is for homeowners that are 62 is the minimum. So if it's a married couple, the older of the two would need to hit 62. If the other spouse is less than 62, that's okay. One has to be at least 62. So there is the ability to actually take equity out of your own equity. So say maybe you have a $300,000 home and you've already paid off $200,000, but you're still paying payments as if it was a $300,000 loan. And for some people, if they've retired or, things in life have changed, if they have something come up with their health or just any kind of life change, and their income has changed, then having that mortgage payment the way that at the same amount that it was, when they were 42 and in the prime of their earning, might not be as easy, but maybe they're not ready to just sell their house and downsize. Um, they could actually take out equity out of that house. And it could be in a lump sum, or it could be like a monthly payment actually that the mortgage company then makes to them. So this means that, they could actually get income from their house. And they can do whatever they want with it. There's no limit on whatever. They could travel, they could pay off other debts, they could pay medical bills, they could do whatever they want. There's truly no limits on, because it's their money. Um, Now what the requirement is that they do have to keep on paying property taxes and homeowners insurance. That is still the homeowner's responsibility. So that's just something to keep in mind too. And then if there comes a time when that home is in the, goes to the heirs of the owners, then they're going to have options too. They can either repay the equity and keep the house. They're not just out of the house. They'll have options when that time comes too.
Okay. Well, that is a great option for people, like you just said, like maybe they have unexpected medical bills come up or something like that. That is a really good option if they have that equity in their home.
Because 30 years is a long time when you sign up with a mortgage, or you start with a mortgage. And a lot of things can happen over the years to change your needs and income and those kinds of things.
I agree. And you're right. I have seen so many commercials, and it's so funny you said that. Usually during the day, during when the Price is Right is on.
Yeah, they seem cheesy.
They do.
Yeah.
They make it seem weird, but the way you explained it is actually really beneficial.
Yeah, and it's certainly not for everybody. Even if you're 62 and up, it doesn't mean that it's going to be the best thing for you. So there's actually home counseling that is required with it.
Okay,
So to make sure that it's really going to be the right fit for that person.
got it.
Yep. Okay, so down payment assistance. This is something that we get questions about a lot, especially from first-time home buyers, and especially with, like, the market being a little bit higher in purchase prices. So down payment assistance is something that it's a program that we can offer with an FHA loan. So it's not a separate kind of FHA loan. It would be a regular FHA loan, but instead of the buyer having to save up that 3.5% or take it, maybe out of a retirement account, which I don't think we mentioned that, but that is an option if someone has that amount for their down payment in a retirement account. They can make a withdrawal. It is a doable withdrawal from their retirement account. And I'm not giving legal advice to do so, but a person can do that.
Sure.
So, I mean, that's just definitely like a conversation they would want to have. But that is an option. But a down payment assistance is a program that can work hand in hand with an FHA loan. So if a person just maybe doesn't have it saved up yet, or they don't have a fund they can draw it out of, or they don't have a family member that could gift it to them, then the down payment assistance is definitely something to look at. It can pay that 3.5%. And then that just leaves, it's just a lot lower cost of entry into, that home or that mortgage. And there are two aspects or two roads you can go on with the down payment assistance. There is repayable, and then there is non-repayable. And they both have their pros and cons again, but just kind of in a nutshell, the repayable, um, it is there. Well, they are both actually a second lien on the home for that time period until either they are repaid or the 3, or sometimes it's a 5-year increment. Once that person has just made their regular mortgage payments for those 3 or 5 years, then it's forgiven, it's done, it's gone. Now, on the flip side of this program, and I think it's important for people to know because FHA generally has some of the lowest interest rates of any loan program. With a down payment assistance program, that will normally make that interest rate a little bit higher. Just because for the lender, there is a little bit more risk in that loan because there's not so much, maybe what you would say, skin in the game in the beginning. So that is something that maybe after that 3 or 5 years, you might consider even refinancing at that time, just to enjoy that lower interest rate that FHAs normally have.
I am a really big fan of the down payment assistance program because, I think sometimes we don't remember it's really hard to buy a house. I mean, especially if you've never bought a house, it's really hard.
Mhm.
And, right now we're in the year of 2025. I mean, things cost a lot. I mean, people's expenses have gone up dramatically. And so I really think this is such a good way to get people into a first home. It doesn't have to be their forever home, as people say, but
Right.
it's such a good way. I've had so much success with helping people get into a home and then, even us asking the seller for concessions and really a very low out of pocket cost to buy their first home. So I personally love it. And I know, you did say that the interest rates are a little bit higher, but I think which would increase the monthly payment a little bit more.
Mhm.
However, it's like, you know, I'm so glad these programs exist.
Mhm. It in the right situations, it can really be kind of a just allow that person to go ahead and purchase that home and then over time, be
Mhm.
able to get back into that lower interest rate.
Yes, I
Yeah.
agree.
So the streamline refinance, I'm glad you brought this one up. The streamline is a great thing to keep in mind. FHA, I'm sure everybody's heard of, refinancing a mortgage, and you can refinance any mortgage. But FHA has a special refinance. If you refinance from an FHA loan. So say you buy an a home with an FHA loan and you think, well, I'm not sure I really want to buy right now because interest rates are supposed to fall through 2026. And that is what we hear. I think it's a good likelihood. They have come down, a little bit already in 2025. We're at a pretty good point right now. We could see a greater drop in 2026. But sometimes, and you've probably seen this, Jennifer, when interest rates fall, sometimes it's sort of like um, a balancing between interest rates may fall, prices may go up. So it's not always exactly, but it's better to just go ahead if you're in the position to go ahead and get pre-approved and see about doing your purchase because if rates fall, you can always refinance after you've made your sixth payment with an FHA mortgage. And so the nice thing about this streamline, what makes it a streamline, is that you usually do not have to have an appraisal. So that's a little cost saver. You do not have to go through the whole process that you do with the original purchase of proving all of your income. And there's not, as we don't do a a full credit pull. We just do just the trade line of the current mortgage to ensure that you have a history of paying those on time. And if so, then that's really um, um, pretty much all you need on that, kind of a recent mortgage statement, just so we can see, what still needs to be paid off on it. But after that sixth payment on an FHA, that streamline becomes available. And so there would still be a little bit of closing costs. There would still be title fees, for example. But it is less than a purchase because there's generally no appraisal. So, and just a lot less documentation to pull together, not all your W-2s, and then some instances, tax returns for self-employed and all that.
That's a really good program.
It is. It makes it easy to just enjoy, like, get your interest rate down. And actually, they have to protect the homeowner. The interest rate would need to go down at least 0.5% in order to do the streamline refi. And so, like right now, I'm seeing, that's definitely doable for a lot of
Okay.
people that purchased in, 2020 4 or 2025, and now interest rates are getting better. So we're looking and definitely seeing that. I have one coming up. We're just waiting till that six payment's made in January, and then we're already planning to do the refinance. So that's just something to keep in mind if someone's hesitant, that they're not stuck in an interest rate forever. And this is like
Sure.
a less expensive way to do a refinance with a lot less hassle, a lot less paperwork.
Nice. Okay, I went to the next slide. I don't know if you see it.
Oh, I do see it now. So
Sorry.
yeah, this is just a little bit of a recap and to kind of spur if anybody has any questions. Love to, hear anybody's questions. But just kind of in a nutshell of why I'm a big fan of the FHA, um, mortgage, because it does generally have a lower down payment. That 3.5% is what I see for probably 95% of my FHA loans. So there is the highest parameters for that debt to income ratio allowance, which again makes it easier for if there is a lower income, or if there's just some other monthly debts to like have to fit into that, or it can actually, I've been able to do a pre-approval for some people. If I can do a dual pre-approval between, for conventional and FHA for home buyers, I do that just to give them all of their options. But sometimes the FHA pre-approval will come in at a little bit higher price point because you can just fit more into it. So I like that about it. Just gives people more options. And ultimately, picking your loan, I'm not here to say that FHA is the only good loan. It is a very good loan. It's a very strong loan, and it's got a lot of like flexibilities to it. But ultimately, I like for home buyers to have the choice to make the decision that is really going to get them to their goals and what they want to do. It's got some of the lowest rates of all the loan types. It has the multi-unit options up to 4 units, as long as you're planning to live in one. That's the important thing to remember, is that you do need to make one your primary residence. And if a few years down the road something happens, you move or something, of course that can change. You're not locked in there forever, but it does need to be your primary residence, and that needs to be the intention when you buy it. Since it would not be considered an investment loan. So then there's the renovation financing, finding one that is a fixer-upper. We can flip it and do, or not flip it in the sense of house flip, but flip the FHA to a renovation loan, and look at doing those renovations bundled in with, because a lot of times if a house needs a lot of repairs, you can get it for a lower price. So if you can get it for that lower price, add in the renovation costs, then a lot of times you can even come out better than if you had bought that home already repaired. You still have a little bit less principal in that. So Streamline Refinance is a great way to save money throughout the life of your FHA mortgage so that you can, as rates go down, as long as they go down a 0.5% and you've made those 6 payments, we can do a pretty easy refinance to just, help you enjoy those lower rates. And then there's the down payment assistance options.
Which I love all those options. And I'm going to look at the chat and see. Okay, I'm going to read some questions if you don't mind. Is that
Oh,
okay?
sure. Yes, please.
Oh, well, someone did say Jen was talking about, yeah, she's looking at that to possibly buy a triplex or fourplex this upcoming year where they're going to
Okay.
occupy one unit. So that would be really good.
Awesome.
Um,
Yeah.
Here's a question. So if a seller has an outdated home, for example, okay,
Mhm.
and maybe a home that needs some repairs, do
Mhm.
you recommend getting some contractor estimates before listing it and marketing it as a potential 203K loan?
I do think that you can attract more buyers, and that's a great question. Marketing it as a FHA renovation type of home, and that it could um, qualify for that kind of financing. I don't know if getting the estimates, if you would want to go ahead and do that or not, because I think each home buyer might have different things they want to change or update, or so they would probably need to get those through a HUD contractor. But I do think it's a great marketing tactic, because you're going to like just attract the attention of a lot of people that may not have even thought about it or might overlook it, just with the, because most of the time we think of FHA, we think pretty strict appraisals and it needs
Yeah.
to be pretty tip top. But it's going to open a lot of people's eyes to the possibilities. It's a great
Well, you
marketing.
know what? That is such a good question because I'll be honest with you. I think I personally don't think I've ever, and I'm sure there has been, but I don't think I've ever seen one marketed as that. And that's actually, yeah, now
Mhm.
that I think about it, that's a really good way because I will be honest, a lot of listings sometimes I see if I think if the seller knows the home's kind of in a worse condition, they
Mhm.
actually sometimes say, only eligible for conventional or cash or whatever. So,
Right.
and that's, uh, that with marketing it as a potential 203K, that's actually really smart.
That's a great idea.
Yeah. Jen Jennifer Bradford is very smart. Um, yeah, does anyone else have any questions at all? I mean, we are going to send this recording out so you can listen to it again. We can send the slides out as well, but we recorded this, so we're going to post it on YouTube and everywhere else. But I am just so thankful because, we try to stay in our lane as real estate agents, but I love to know the different products out there, so
Mhm.
we can at least give our buyers some options and then pass them over to you for more detailed explanation. But I just think it's so
Right.
great. And honestly, I did not know about all the different types that you mentioned. So it's really smart. And, we're always trying to educate you as well. You're always trying to educate buyers. We are always trying to educate buyers. So I think this is
Mhm.
such a good way to do that. And maybe next time we can kind of talk about conventional loans because again, it's funny you said this, uh, to this day, and it's 2025, to this day I have buyers coming to me saying I don't have 20% down, and they
Right.
really honestly think that that is the case, and it shocks me because it's just nothing could be further from the truth because
Right.
like you said, there's 3%. We did a 5% conventional. So it's like there's
Mhm.
so many different options out there.
Yes, I would love to do that as well because conventional definitely has a lot of strengths of its own. So
Yeah.
yeah, we could definitely do that.
Awesome. Does anyone have any questions? I don't think they do. But of course, Karla, you can tell them your information. We're going to put it, when I post the video, we're going to put it below. But so you're with Approved Mortgage. We're going to, put your email and phone number down. But yeah, you're licensed in Indiana, is that right? Or anywhere else?
Yes, so I am licensed in Indiana. Approved Mortgage is actually licensed in Michigan, Indiana, Kentucky, Tennessee, and Florida. So we do
Florida.
have, I
Okay.
have teammates that have licenses in those other states. So if somebody is interested in, looking in any of those other states, I can, have great teammates that can step in and help for sure.
Awesome. This
So
has been so great. And I just love this because I love learning about the different things. And I know it's very helpful for buyers. So thank you so much. I really
you're
appreciate it.
welcome. Thanks for having
And
me on.
of course, I hope you have a great night. If you want to stay on for a minute, that would be great. Thank you.
Sure. Thanks, Jennifer.